Hello and welcome to RCLCO's January macroeconomic update. I'm Scott Bommarito, and today we'll briefly look at how a handful of economic indicators closed out the year. Headline and core CPI inflation both steadily declined over the course of 2023, but they ended the year still notably above the Federal Reserve's inflation target. Annual headline inflation closed out the year at 3.4%, ticking up 30 basis points from November's reading. However, the 2023 inflation rate was well below the 2022 year-end rate of 6.5%, as elevated interest rates have materially slowed the economy. Similarly, core inflation ended 2023 at 3.9%, well below the prior year's 5.7%, but again, still above target. Economists project further cooling of inflation, but expect it to be gradual, with a return to 2% inflation likely in late 2024 or possibly early 2025. Now, shelter CPI, which comprises over a third of headline CPI and over 40% of core CPI, should continue to decelerate based on its lag to market rent indices, most of which have already turned over. So that should provide some baked-in deceleration for the headline and core indices going into 2024. One of the most pertinent economic trends of 2023 was high interest rates. US Treasury rates were elevated across the yield curve and rose steadily, particularly from April through October of this last year. As the left-hand chart here shows, the US Treasury yield curve was inverted throughout the entirety of 2023, meaning that shorter-term yields were higher than longer-term yields. This trend held up through year-end as medium and long-term yields moderated somewhat in November and December, but short-term yields remained elevated. The 10-year US Treasury yield closed out 2023 at 3.88%, which is the same rate at which it ended 2022. However, the annual average rate was 3.96% in 2023, which is over 100 basis points higher than the 2022 annual average of 2.95%. Now, in the first few weeks of the new year here, interest rates have ticked higher again, with the 10-year rate rising above 4.1% and even approaching 4.2%. Rates are likely to remain high in the near term. And one of market participants' most pressing questions, of course, is when the Fed will issue its first rate cut. Expectations generally range from March at the earliest to September on the later end of the range. The Fed's tone was considerably less hawkish at the end of 2023 than it was earlier in the year, which has caused some economists to expect imminent rate cuts. Here at RCLCO Fund Advisors, we anticipate the first rate cut around Q3, given the continued signs of economic strength, particularly in the labor market, to which we will now turn. The labor market was strong throughout 2023 as job growth continued to outperform expectations that were set at the start of the year. Monthly growth figures remained robust, but did cool over the course of the year, and most initial growth estimates were revised somewhat lower in subsequent months. This trend persisted in December, which registered higher job growth than expected, even as October and November estimates were revised down. Annual employment growth totaled 2.7 million in 2023, well shy of 2022's 4.8 million figure, but still above the pre-pandemic annual average of 2.2 million. The labor market is projected to cool markedly in 2024 alongside the broader economy, and employment growth is expected to be more modest in coming years. Consumer sentiment was volatile throughout the year, but generally trended up. The University of Michigan's Consumer Sentiment Survey averaged 65.4 in 2023, well below its long-term average of 85.6, but a notable improvement from 2022's average score of 59. Sentiment ticked up to 69.7 at year-end, as consumers' outlook on business conditions improved and inflation fears eased. The preliminary January result registered another significant increase as sentiment ticked up to 78.8, the highest rate since July of 2021. So good news on the consumer sentiment side, which we expect to continue through 2024. That concludes our first macroeconomic update of 2024. Make sure to follow along for more updates and tune in to our monthly webinars throughout the year.